Hello, welcome to today's discussion of accounting for income taxes as it relates to charitable contributions. Before we begin our discussion, we'd like to go over the agenda today. We will start with a discussion of contributions in general, then the types of charitable contributions, the financial reporting issues, tax reporting issues, and finally the accounting for income taxes. With relation to financial accounting rules, contributions made shall be recognized as expenses in the period made and as decreases of assets or increases of liabilities, depending on the form of the benefits given. For example, gifts of items of inventory held for sale are recognized as decreases of inventory and contribution expenses, and unconditional promises to give cash are recognized as a liability such as payables and contribution expenses. When looking at the valuation of the contributions, we sometimes have to deal with gains or losses. If the fair market value of assets transferred differs from its carrying amount, a gain or loss shall be recognized on the disposition of that asset. Contributions made shall be measured at the fair value of the assets given, or, if made in the form of a settlement or cancellation of a donee's liabilities, at the fair value of the liabilities canceled. There are two types of contributions. There are cash and non-cash contributions. Non-cash contributions indicates that some form of service or property has been transferred for the charitable contribution. The first type we will discuss is cash as it relates to financial reporting. With cash, there are promises to pay. There are two types of promises to pay. Conditional. A conditional promise to pay indicates that a gift will only take place based on the occurrence of a future act. Unconditional relates to a gift that will take place and is to be measured at net settlement value if expected to be paid in 1 year or less. There is also a settlement or cancellation of donee's liabilities as a way of charitable contributions. The evaluation in this scenario is the fair value of liabilities canceled. For example, XYZ Accounting completed Hallelujah Church's tax return. The receivable for the tax preparation services on XYZ's book is $500. XYZ decides to cancel Hallelujah's debt as a contribution to the church. At the time of the contribution, the receivable is worth $480. The entry to receive or record the contribution would be as follows. Charitable contribution expense of $480, loss on debt forgiveness of $20, and a credit to accounts receivable of $500. Next we will discuss non-cash contributions. The valuation of non-cash contributions shall be measured at the fair values of the assets given. Similar to cash, there is a gain or loss recognition principle. If property given as a contribution, the fair value is the amount that is reported as contribution. Therefore, a gain or loss will need to be recorded for the difference, if any, with relation to the property's carrying value. For a non-cash example, please listen. ABC Corporation gives stocks to their church. The stocks are valued at $100, but only have a book value of $70. The entry to record the contribution would be charitable contribution expense of $100, credit to stocks of $70, and a credit to gain on disposition of stocks of $30. Next we will discuss the tax reporting issues. Contributions are only deductible to the extent that they are made to qualified organizations. With tax reporting issues and when dealing with cash, there are substantiation rules. The substantiation rules basically require some sort of written communication of the contribution, such as a receipt. Gifts over $250 require contemporaneous written acknowledgement. There are deduction limitations for tax reporting. A corporation can only deduct up to 10% of their net taxable income before including NOLs. Any amount not used can be carried forward for 5 years, after which it will expire. An example, consider a contribution of $400, but the net taxable income for the company is $3,000. With a 10% limitation, that means the actual deduction can only be $300. If a promissory note is given, the contribution is not deductible until payments are actually made. If a contribution has a conditional stipulation, the contribution is not deductible until the condition no longer exists, unless there is only a negligible chance the condition will actually take place. For non-cash tax reporting issues, valuations are similar. Tangible property is valued at fair market value. Intangibles, such as patents or copyrights, are valued at the lower of fair market value or basis. For gain or loss recognition, the following applies. If the fair market value of property donated is more or less than the carrying value, a gain or loss will be recognized if the full fair market value is being deducted as a charitable contribution. With non-cash contributions, the substantiation rules actually get a little bit more complicated. For less than $250, a receipt or reliable records will be sufficient. Between $250 but less than $500, the donor must provide contemporaneous written acknowledgement. Between $500 and $5,000, in addition to the above-mentioned requirements, the taxpayer must complete Form 8283. If the amount of the contribution is over $5,000, in addition to the above, the taxpayer must obtain a qualified appraisal. For any contributions that are over $500,000, the stipulations are the same as above, but the qualified appraisal must be attached to the return. There are deduction limitations similar to cash with non-cash, except they can only deduct up to 5% of net taxable income calculated before any net operating losses. Once we've finished our discussion here of tax reporting issues, we'll move along to accounting for income taxes. As you will remember, when accounting for income taxes, there can be temporary or permanent differences. We'll start first with the temporary differences. Under temporary differences, we can have a current tax benefit, which is defined as the reduction in tax liability resulting from the decrease in taxable income from the deduction of the charitable contributions. There can also arise a deferred tax liability, which is the portion of the benefit that will be recognized in future years as the carry forward of charitable contributions are used. However, a valuation allowance may be necessary if there is a chance that any of the contributions will not be deductible in future years. For example, in the previous given example, Happy Corporation had made $400 in charitable contributions, but only $300 was deductible for tax purposes. Assume a tax rate of 35%. The journal entries would be as follows. Taxes payable, $105, and a current tax benefit of $105. To record the reduction of taxes payable resulting from the charitable contribution, we will have a deferred tax asset of $35 and a deferred tax benefit of $35. Permanent differences can occur with charitable contributions in the event that some of the charitable contributions will be disallowed or non-deductible. For example, assuming contributions are made to organizations that do not qualify under the Internal Revenue Code. This concludes our discussion for accounting for income taxes as they relate to charitable contributions. The following slides show our references for information and for places to look in case you decide you want to do any more additional research. Thank you.